Hello, today we are going to solve Jan 2025 paper question number 1B part 2. So statement of financial position at 31st December 2024. So let's prepare the statement of financial position at 31st December 2024 for the partnership Aaria and Benul. So the first one is going to be for Aaria and Benul. The first one is going to be non-current assets. So let's see what are the non-current assets they have. They have three non-current assets: delivery vehicle, computer equipment, and fixtures and fittings. So non-current assets, okay, at cost, non-current assets. Then you have delivery vehicle, computer equipment, and fixtures and fittings. Okay. So for these three non-current assets, the values are, okay, the 72 and 40 and 23,000. So let's put that. So the cost is the cost is 72,000, 40,000, and this one has been adjusted as 23,000. Okay, and then we have to have the provision for depreciation. So what was the provision of depreciation? We have to add, okay, this year's provision which had not been included. So 20,000 plus the provisions of depreciation which we have calculated, we have to add. So let's add that. So 20,000 plus 18,000. So that's equal to 38,000. Then for computer equipment, this year's provision was computer equipment. This year's provision was 7,000. So let's add to that. So 12,000 plus 7,000. That's equal to 19,000. Then we have fixtures and fittings to be around 13,200. And this year's, okay, provision we had calculated as 2,300. So let's add that. So plus 2,300, that's equal to 15,500. So now let's write the provisions. Okay, total accumulated provision, so that is 38,000, and then we have 19,000, and then we have 15,500. So this was total non accumulated depreciations. Okay, now because of that, then we will find the current value of the assets. So 72, okay, 7, so we will have to find the carrying value or the carrying value of the asset. So 72,000 minus 38,000, which is equal to 34,000. Then we have 40,000 minus 19,000 will be equal to 21,000. And then we have 23,000 minus 15,500. So 23,000 minus 15,500, that's equal to 7,500. So let's write that also. So now we have to add all these carrying values to find the asset, the total value. Okay, so the total cost, total accumulated depreciation, and total carrying value of the non-current assets. So let's add 72,000 plus 40,000. 72,000 plus 40,000 plus 23,000, that is equal to 135,000. So let's write that. So the total cost of all the assets is 135,000. Then we have accumulated depreciation. Let's add up 38,000 plus 19 plus 15,000. Okay, 15,500. So 38,000 plus 19,000 plus 15,500. So that's 72,500. So let's write that. And then we have the total carrying value. So 34,000 plus 21,000 plus 7,500. So that's equal to 62,500. So let's write that. Next we have to add the fixture, the current assets. So let's see what are the current assets they have. The current assets are going to be first inventory. So the closing inventory we have to take. Closing inventory was 62,500. So let's write that. Okay, that's the closing inventory, 62,500. Then you have trade receivables, which was at 41,000. Okay, trade receivables, but there was an irrecoverable debt, so we have to subtract, okay, that and put. So trade receivables, so it was at 41,000 minus one irrecoverable debt of 3,000 had happened. So let's subtract these two and then put the value. So that is equal to 38,000. That's trade receivables. Then we have provision for irrecoverable debt. Okay, the provision for irrecoverable debt for this year was calculated as 1,900. Okay, 1,900. So let's write that. So this was calculated like 38,000 and the here. So it was third 41,000 minus 3,000, which was irrecoverable debt, and 5%, okay, at the rate of 5% will give you 1,900. That's a provision for irrecoverable debt which has happened this year. So this has to be subtracted. Then let's see if there are any other receivables. So the things that were prepaid, okay. So let's write other receivables. So expenses prepaid becomes other receivables. This became other receivable. Okay, 400. Then this expense, there was one more prepaid expense of 600 which became other receivables. So let's write that. So the other receivables, so expenses prepaid had become other receivables. So these two became other receivables. And then what was a cash and bank? So let's see if there was a cash and bank. Cash and bank were around 8,400, which is a debit, which is a current asset. So cash and bank. So this one, sorry. So this one, other receivables, it had become 400 plus 400 plus 600. That's 1,000. And then we had cash and bank, which has a debit balance, which indicates that it is a current asset. If it was a credit balance, it will indicate it is a current liability. So cash and bank, so it was around 8,400. So let's now add up the total assets. So 62,500, 62,500 plus 38,000, okay, minus 1,900, 90. So let's write this, okay, separately. So we will have to write, so this 38,000 minus 38,000 minus 1,900, that is 36,100. So 36,100. Now let's add up all these values. So it is 62